With me now is Steve Parrish. He's an adjunct professor at the American College of Financial Services in Radnor and the co-director of the American College Center for Retirement Income. Steve, thanks for being here.
My pleasure.
So we've been hearing this word bear market, and we've moved into a bear market. For people who aren't financial experts, what does the bear market mean, and how does it matter to the average person?
Well, it simply means that there's downward pressure on stocks. And so there's things going on in the economy that's causing the market in general, not just one company, to have the value of their stocks go down. So it could be interest rates going up, it could be inflation, it could be the war in Ukraine. All those kind of things are putting pressure on companies that's bringing down the value of their stocks.
So that's going down while we are paying more for just about everything. And now the interest rate has gone up. And people are saying, I don't understand that, because that means I'm already paying more for gas. I'm already paying more for food. Now I'm going to pay higher credit card bills and higher loan payments. How does that help the economy?
Well, it's a case of tough love, because really you have the Federal Reserve having the duty to keep a handle on inflation. And obviously we have inflation, and it's hitting us pretty hard right now. So the one big tool they have is to slow down the economy. And the way they slow down the economy is they make it more difficult for businesses to borrow money. That causes, yes, I agree, mortgage rates go up and borrowing on a car go up. But it's, again, a case of tough love, because more important than anything is to get a handle on inflation. So by doing this, what they're essentially trying to do is tap the brakes a little bit to slow down the economy. And yes, that has pain to the consumer, but in the long run, that may be less painful than just having prices go out of whack and be uncontrollable.
Steve, let's go back to the stock market for a second, help people understand how they are impacted. Many people may not realize that their company 401k is impacted by the market. Their savings for college through 529 plans, that could drop as well. So tell me all the impacts from what's happening in the market right now.
Well, first of all, I think you want to celebrate that you have this to worry about. In other words, it's great that you've been saving. And so when you get into a rough economy like this, it should be comforting to know that you have some money put aside for there. But I recognize that also means there's downward pressure on the prices of stocks, which is going to affect how much you have in your 401k or your 403b or whatever. The fact is that what goes down tends to come up. And so it hopefully is something that is a shorter term concern than a long-term concern. In other words, you don't want to get out just because the market is down right now. Probably patience is more important than profit right now as we wait out and see where the economy takes us going forward.
So patience and don't panic, because I'm sure most financial advisors are telling their clients right now, stay the course, it will come back, right? But what if I'm close to retirement? For people close to retirement, they're saying it'll come back. Historically, it always has. But how long is that going to take?
Right, and no one has a crystal ball, but let's think about this. Remember the Great Recession? Okay, so in April of 2009, the Dow Jones, just as an example, was around 11,000 points. And 2 years later, it was up around 16,500. That's a 50% increase. So that, even with the Great Recession, it started to recover well in 2 years. Now, for the person that's getting very close to retirement, what they can control certainly isn't the economy, but they can control on the expense side. So some fairly practical considerations. One is, if you can keep working, maybe you should keep working for a while, just because it's a good market where you can negotiate, it's unemployment is low, and that really feeds into your 401k and puts more money into Social Security. And it's a shorter period in retirement where you're taking out from savings. Or another would be to make sure you defer pulling out your Social Security as long as you can, because that is the one investment you own that really is inflation adjusted. Last year, it was 5.9%. They're even talking about a cost of living factor over 8% on Social Security for this year. So maybe you can control the expense side while we ride this out, because there's not a lot you can do on the growth side of your investments, because it's right now kind of across the board.
Also, let me ask you about credit card payments, because credit card debt is significant for many, many people. And they should start to see in the next couple of billing cycles an increase in their interest rate. What's your best advice for them?
As always, to pay down those credit cards as soon as you can. You don't want to go into deep further debt, but those rates tend to be very high, and they're going to be very reactive to this change from the Fed. So as soon as the Fed makes it tougher for companies to borrow money, they're going to react, and they already are reacting very quickly. So be ready for an increase in the interest rate you pay on your credit cards. Do what you can. Maybe you pull out from cash value of life insurance or other sources that you could grab and use that to pay off some of that very expensive debt.
Yeah. Are there savings options that aren't tied to the stock market? If someone just says, well, you're saying stay the course, but moving forward, if someone says, I can't handle this up and down, I just can't.
Right. And it's not really an alternative of one versus the other, because we are in a situation where you truly have a bear market where a lot of the markets aren't doing well. So stocks aren't doing great, bonds aren't doing great, cryptocurrency certainly isn't. So that's why we say that stay the course, not because one's better than the other. And also, if you're going to move into something that makes you more comfortable, that it causes you to have less butterflies, maybe this isn't the right time to do it, because that means you're going to be moving out of your stocks at a loss. Maybe you've learned a lesson, but my advice would be hold on for a while so that you can at least ride this out. And then maybe you look and go, look, I'm getting closer to retirement. Maybe going forward, I need to make myself a little more comfortable. And the one thing you can control, as I said before, is more on the expense side, and let the market do its thing, and hopefully it will recover soon.
Fingers crossed. Steve Parrish with the American College of Financial Services. Steve, thanks so much.
My pleasure.